welcome to the week there was. You know, typically, when you look at a financial chart, you just see a flat line. Your immediate assumption is that absolutely nothing is happening,
It
right?
feels totally stagnant.
Exactly. It feels dead. But as we were going through the stack of daily market digests and intelligence reports for you today, a better analogy came to mind. It's not a frozen pond. It's a gyroscope.
Oh, that's a great way to put it.
Right. Because on the outside, a gyroscope appears perfectly still. It's balanced, it's locked in place. But the only reason it appears so stable on the surface is because internally it is spinning at this incredibly frantic, violent speed.
Right. It's the absolute definition of a mechanical illusion.
Exactly. And that's our mission for today's deep dive into these reports. We want to extract the signal from the noise for you. Because to a casual observer, this market seems, well, incredibly boring right now.
So boring.
But beneath that calm exterior, we are tracking this massive real-time restructuring of global finance, the physical energy grid, and even nation-state cyber warfare.
Yeah, and when algorithmic market makers step in and suppress that price volatility on the surface, it practically forces us, and, you as the listener, to look deeper at the structural plumbing.
Because that's where the real action is.
Exactly. When the surface is quiet, that is exactly where the real story lies.
Okay, let's unpack this.
Okay.
Because the surface level truly is flatlining. I mean, we're talking about an asset trading in this highly constrained band, roughly between, $62,000 and $65,500.
Yeah, a really tight window.
And the trading volume has dropped over 20% across the major fiat channels. The reports indicate that these algorithmic trading desks are running what they call delta-neutral strategies,
Right.
which is essentially neutralizing any natural market volatility.
Let's clarify exactly how that works mechanically, because delta neutral sounds super complex, but it's really just a strategy of perfect hedging.
Okay, break that down.
So these algorithmic trading desks are taking positions that completely offset each other. If they buy the underlying asset, they simultaneously sell a derivative contract against it.
So they don't actually care which way the price goes.
Exactly. Their goal isn't to guess if the price will go up or down. Their goal is just to profit from the trading fees, and the tiny little spreads between those positions.
Wow.
And by doing this at a massive scale, they're constantly capping the upside. They sell when the price bumps up, and they buy the dips when it drops.
Which creates that high-friction consolidation zone we're seeing.
Right. And the fast retail money gets incredibly bored because, well, there are no massive price swings to trade.
Right. And it's happening against a very tense macroeconomic backdrop. Over in the physical world, oil prices are surging to $82 a barrel.
Yeah, mostly due to escalating geopolitical tensions in the Middle East.
Exactly, and supply chain bottlenecks. And then you look at the wholesale inflation report, specifically the producer price index, showing a headline annual rate of 4.7%.
Which is elevated.
Very. That petrochemical and transportation cost is just keeping pressure on the whole supply chain. Meaning the central bank has absolutely zero analytical incentive to reduce interest rates right now.
Right. The cost of borrowing capital is pretty much locked in place, which, leaves the massive pools of institutional capital in this highly cautious wait-and-see mode.
Right.
But while they wait on the sidelines of the spot market, they are completely rewiring how they interact with this asset class behind the scenes.
Okay, yeah.
If we connect this to the bigger picture, the most fascinating structural shift right now is happening in the derivatives market.
Yes. The great offshore migration. This is a huge standout in the digests. We're seeing U.S. institutional cash and carry basis trades just rapidly unwinding.
Winding fast.
Open interest on the Chicago Mercantile Exchange, the CME, is plummeting to multi-year lows. Meanwhile, offshore platforms like Binance are suddenly taking the lead.
Taking the lion's share of futures open interest, yeah.
But wait, at the exact same time, the assets correlation with gold has flipped dramatically. It went from negative 0.9 to plus 0.7.
Right, so it's acting as a macroeconomic hedge now.
Exactly. So I have to push back here. If institutions are viewing this as a safe haven macro hedge like gold, why are they simultaneously unwinding their domestic futures trades and moving offshore? I mean, doesn't that totally contradict the narrative?
It sounds totally contradictory, I know, but it actually highlights two very different types of institutional players operating right now.
Okay.
The drop in CME open interest isn't about people losing faith in the asset. It's entirely about the mechanics of the basis trade itself.
Right.
A basis trade is simply exploiting the price difference between the spot market, what the asset costs today, and the futures market, what people will pay next month.
So mechanically, you buy the actual asset today for, say, $60,000.
Right.
And you simultaneously sell a futures contract promising to deliver it next month for $61,000. So you lock in a completely risk-free $1,000 profit.
Precisely. You don't care if the asset crashes to zero or goes to $1 million because you are perfectly hedged.
You're just harvesting that yield.
Exactly. But as U.S. markets mature and get more efficient, that price spread tightens. Those easy, risk-free yields just dry up. So the fast money, the quantitative hedge funds, the algorithmic guys, they're unwinding those domestic trades and moving offshore. Because offshore platforms offer higher leverage, more volatility, and ultimately wider spreads to exploit.
Okay, so the drop in CME volume doesn't mean institutions are fleeing. It just means the yield farmers are packing up and moving to a more volatile jurisdiction.
Exactly. And they leave the domestic spot market to the long-term macro allocators, the pension funds, the sovereign wealth funds.
And they're the ones driving that positive correlation with gold.
Right. They're actually buying the spot asset or the physically backed ETFs to hold as a hedge against inflation.
Well, here's where it gets really interesting. Because when you look at those long-term macro allocators, they're getting incredibly creative about how they accumulate.
Oh, absolutely.
Let's talk about corporate treasuries and what the reports are calling shadow accumulation. Look at Norway's sovereign wealth fund.
Oh, yeah, this is wild.
They just hit a record holding of 11,549 units of indirect exposure. That's over $700 million, a 60% jump.
Which is massive for a sovereign wealth fund.
But here's the kicker. 86% of that exposure comes purely from holding equity in one single company, Strategy Inc.
Right.
It's like they want to profit from the game, but instead of buying a stake in the sports team, they just buy the physical stadium the team plays in.
It is a brilliant, highly calculated backdoor strategy because traditional finance is desperate for exposure, but holding the raw bearer asset directly, that involves immense regulatory and custodial hurdles.
Right, like if you lose a private key, the money's just gone forever.
Gone. A sovereign wealth fund can't risk that. So they buy equity proxies, shares in a publicly traded software company that just happens to hold a massive amount of the digital asset on its balance sheet. But this strategy is actually facing a massive mechanical existential threat right now from the index providers themselves.
Oh, right, the MSCI index threat. I read this. MSCI is considering a rule that would mechanically remove companies from their global indexes if their operating assets fall below 50% of their total assets.
And that is a direct threat to treasury-heavy companies like Strategy Inc. and Metaplanet.
Why is that such a big deal mechanically?
Well, let's walk through it for the listener. If a company is just acting as a shadow holding vehicle and their actual legacy software business shrinks below that 50% threshold, they get kicked out of the MSCI index.
Right.
And because so much of the global stock market runs on autopilot through passive index funds like Vanguard or BlackRock, those funds are algorithmically forced to sell the stock the second it leaves the index.
Wow. So it triggers this automatic, completely unthinking wave of selling pressure.
Exactly.
And on top of that index threat, these companies are getting absolutely hammered by current GAAP accounting rules.
Oh, the accounting rules are brutal.
The report showed Trump Media took a $190 million mark-to-market impairment charge because the price of their digital asset holdings dipped, even though their operational revenue is tiny.
Right.
And Stablecoin X took a $34 million net loss on a non-cash impairment, despite holding 3 billion tokens and growing their core operations.
We really have to explain why GAAP rules cause this because it's a severe structural friction. Under generally accepted accounting principles, these digital assets are classified as indefinite-lived intangible assets.
Right.
Mechanically, this means if the asset's price drops below what the company paid for it at any point during the quarter, the company has to record it as an impairment loss on their income statement.
But wait, if the price goes up, they aren't allowed to record the gain until they actually sell it, right?
Exactly.
It's a totally one-way street of financial pain. It treats the asset like a liability on the books.
It completely distorts the company's profitability to investors, which is exactly why traditional Wall Street is stepping in to build wrapper products that bypass the corporate balance sheet entirely.
Which brings us to the Goldman Sachs acquisition. They bought asset manager Neos for $2.2 $1.25 billion.
Yeah.
And this stood out to me because they didn't buy a digital asset company. They bought a traditional asset manager just to get their hands on a $1 billion covered call ETF.
Because Wall Street understands that institutions want yield, but they don't want the regulatory nightmare of self-custody.
So how does a covered call ETF fix that?
It's essentially a mechanical yield engine. The fund holds the underlying digital asset, but then it sells call options against it. So they're selling someone else the right to buy their asset at a slightly higher price at a specific date in the future.
Okay, and they collect a cash premium for selling that, right?
Right. If the price stays flat or drops, the option just expires worthless. The fund keeps the premium. And that generates annualized yields in the mid-20% range.
Wow. So Goldman realized it's just faster and way more profitable to spend $2 billion buying a functional, regulatory-approved derivative income vehicle.
Then to sit around waiting for regulators to approve their own bespoke product.
Exactly. They want the yield and the management fees. The raw asset is just like fuel for the derivative engine.
That's all it is to them.
Okay, so if Wall Street is hoarding all this supply through complex equity proxies and covered call ETFs, we have to look at the people actually generating the supply to begin with. The network miners.
Yeah, and they're in a tough spot right now.
According to the digest, they are facing a full-blown existential crisis. Production costs have absolutely skyrocketed. Riot platforms reported a direct cost of almost $50,000 per coin.
Just to produce a single unit, it's wild.
To survive, these digital prospectors are basically having to cannibalize their own treasuries. We saw Keel liquidating over 1,000 coins just to finance the physical construction of a new data center in Quebec.
They're being structurally priced out of their own core business model. You know, the network automatically reduces the block subsidy, the reward they get for mining over time.
Right.
Meanwhile, physical energy costs and computational difficulty just keep going up.
So their margins are just getting squeezed to death.
Completely compressed. But their response to this is arguably the most significant infrastructure pivot we've seen in the last decade.
The AI pivot.
Yes. They are actively transitioning their physical facilities into high-performance computing and artificial intelligence data centers.
And the numbers involved here are staggering. Riot Platforms just signed a 20-year, $9.1 billion lease agreement with the AI laboratory Anthropic.
$9 billion! Think about that.
Riot is basically providing the physical structure, the land, the massive cooling systems, and Anthropic just brings in their own servers. But I have to ask, are these mining companies totally abandoning their core mandate? I mean, they're transforming from decentralized network validators into essentially high-tech landlords renting out heavy-duty air conditioning and concrete pads to AI monopolies.
It looks like an abandonment of the ethos, certainly. But structurally, you know, it is a brilliant and necessary survival mechanism.
Really? How so?
Think about the physical infrastructure requirements for artificial intelligence. Large language models require continuous, uninterrupted power. 24/7.
They could just power down during peak grid hours.
Exactly. And network miners happen to possess the most robust, high-capacity electrical infrastructure on the planet. But even more importantly, they possess the regulatory permits.
Ah, right, the grid connection queue. The reports mentioned that the Texas government essentially froze 474 gigawatts of pending data center grid connection requests.
Because the physical grid simply cannot handle the demand from these new AI companies.
So nobody new can get in.
Right. And that is the key, because the miners built their facilities years ago. Before this massive AI boom, their massive multi-megawatt draw is already grandfathered into the Texas power grid.
Wow, so that grandfathered connection is massive economic moat.
Huge! You can't just buy that kind of regulatory clearance today. You'd have to wait in line for a decade.
So the miners rent out their grandfathered megawatt capacity to AI hyperscalers.
Yep.
And they use that guaranteed multi-billion-dollar fiat revenue to subsidize their own mining operations and, by extension, network security.
They aren't abandoning the mission at all. They just found traditional tech monopolies to foot their electricity bill.
That's incredible. Okay, so we have billions of dollars flowing into these physical facilities, and Wall Street wrapping the assets in ETFs. Because this ecosystem is maturing and getting so deeply integrated into traditional finance, the target on its back has grown exponentially.
Oh, without a doubt.
And the threats, I mean, they've evolved way beyond some teenager trying to guess a password. We're looking at highly sophisticated, state-sponsored, AI-driven cyber warfare.
What's really fascinating here is how the attack vectors have completely shifted.
Right.
The core cryptographic layer, the blockchain itself, remains mathematically secure. The attackers know there's no point in trying to hack the digital vault directly.
It just takes too much computing power.
Right, exactly. So instead, they attack the surrounding supply chain, the application layer, and most importantly, the human being holding the key.
Yeah, the human is always the ultimate unpatchable vulnerability.
Always.
Let's look at what North Korea is doing. State actors, specifically this cyber warfare group called Kimsuki, are actively weaponizing open-source, local, large language models, like a llama.
Right. And they're running these AI models offline on their own local hardware, which is a really crucial mechanical detail we need to highlight for you.
Okay, why is running it locally so important?
Because when you use a commercial AI, it constantly pings a centralized server, and that leaves a digital footprint. But by running the AI models locally on their own machines, these state actors don't generate any suspicious outbound web traffic. They completely evade the enterprise network monitors and data exfiltration heuristics that cybersecurity firms use to detect malicious activity.
Wow. And they're using these localized, untraceable models to craft flawless, culturally specific phishing lures and deep-fake military IDs.
Yes.
They're specifically targeting the human employees involved in institutional multi-signature custody arrangements.
They aren't trying to crack the code at all. They research an employee, generate a flawless, personalized email, and just convince the guy with the key to hand it over.
That's terrifying. And we're seeing this same structural fragility at the application layer too, right? Like the BTC Pay server exploit detailed in the reports.
That's a perfect example of this.
So BTC Pay is an open-source payment processor used by hundreds of thousands of merchants. And the attackers found an unpatched vulnerability in older versions of the software.
Right. And again, they didn't break the base layer encryption. They just exploited the application to exfiltrate these specific credential files called .macaroons.
.macaroons.
Yeah, a .macaroon is essentially a digital permission slip that applications use to talk to each other.
Okay.
So they bypassed the security, closed the payment channels, and swept the funds completely cleanly. When you operate a sovereign routing node for instant payments, you have to maintain an internet-connected hot wallet,
which requires constant patching, monitoring, perfect operational security.
And if you miss just one software update, your node is exposed.
Man. And it's not even just the digital side that's vulnerable. Look at the Trezor supply chain breach.
Oh, this one is particularly concerning.
Yeah, Trezor makes hardware wallets, which are basically cold storage flash drives for your private keys. The hardware itself wasn't hacked. The cryptography was perfectly safe, but hackers used a simple SQL injection vulnerability, which is basically just tricking a database into revealing its contents by entering code into a search field on a third-party logistics partner called Shipmonk.
They didn't steal digital assets.
No. They stole the names, emails, and the physical home addresses of over 13,000 hardware wallet customers across the U.S., Europe, and South America.
Wow.
Exactly like putting a 3-ton titanium bolt door on a cardboard house, and then the delivery guy just hands out your home address to a gang of thieves.
That is terrifying from a security standpoint. I mean, the digital assets are mathematically safe on the device, sure, but now the physical location of the person holding the device is compromised.
Opening them up to physical extortion or a home invasion.
What people often call a wrench attack.
Right.
And this forces the ecosystem to confront a really uncomfortable reality. To your point about the cardboard house, it makes us question if the original cypherpunk vision of everyone being their own sovereign bank is actually a failed hypothesis for the average person.
Right. Is it just too hard?
Exactly. Will the sheer terror of AI phishing, application layer exploits, and physical wrench attacks just push everyone toward custodial banking-as-a-service models out of sheer self-preservation?
That's a huge question.
I have to concede, the operational burden of self-custody is proving too high for most.
Which brings us perfectly to our final piece of the puzzle. Because as the threats escalate and the capital pools grow, nation-states are no longer ignoring this ecosystem at all.
No, they're stepping right in.
They are actively moving to capture it, control it, and build walls around it. We're essentially entering the era of the global ring fence.
Governments have realized they cannot technologically kill a decentralized protocol. I mean, the math exists, it's out there.
You can't uninvent it.
Right. So the next logical step from a statecraft perspective is to domesticate the liquidity. They want the capital to flow, absolutely, but they want it to flow exclusively within their borders, under their jurisdiction and under their surveillance.
And we saw this mechanical ring fencing play out across 3 different continents just in the recent reports you sent us. Let's start with Brazil. Their central bank is implementing a mandatory 24-hour precautionary hold on outbound transfers over $10,000 if that money's going to a foreign platform or a self-custody wallet.
And by delaying the transaction, they're effectively killing the core feature of instant settlement finality.
Just to stop capital flight.
Exactly.
And then you have South Korea. They're structurally overhauling their entire digital asset ecosystem to domesticate liquidity. They're allowing their domestic mega banks to acquire local exchanges while simultaneously pressuring mobile app stores to block overseas platforms like OKX from even being installed on citizens' phones.
They're literally building walled gardens.
Yes. And in macro geopolitics, we're seeing the network used for explicit sovereign utility.
Yeah.
Look at Russia. Their central bank just authorized retail crypto trading on public Russian exchanges.
And let's be clear, this isn't a pivot toward promoting financial freedom for their citizens.
Not at all. It's a highly calculated mechanical move to crowdsource a parallel foreign exchange reserve so the state can facilitate cross-border trade and completely bypass Western sanctions.
Right. And the U.S. isn't sitting on the sidelines either, by the way.
Right, the OCC.
Yes, the Office of the Comptroller of the Currency just quietly granted preliminary approval for the World Liberty Trust to become a national trust bank.
And the sole purpose of this bank is to run a massive stablecoin operation in-house.
Exactly.
So what does this all mean? To me, it feels like governments are just building highly regulated digital toll booths on the internet. But I have to push back on this whole trend. If the entire original point of this technology was to have a borderless, instant peer-to-peer network, don't 24-hour holds and domestic ring fences kind of defeat the entire purpose?
It absolutely contradicts the original ethos. There's no denying that. But this is the inevitable, brutal price of global macroeconomic integration.
Okay, unpack that.
The underlying protocol, the blockchain itself, remains completely borderless and neutral. But you don't interact with the protocol in a vacuum.
Right.
You interact with it through fiat on-ramps, the exchanges, the banks, the stablecoin issuers, and those on-ramps are highly localized physical entities subject to state law.
Wow.
So the network itself won't be shut down. It will simply be heavily franchised by local jurisdictions who control the entry and exit points.
Wow. Okay, so to bring it all back to where we started with that gyroscope analogy, that quiet, boring price chart we see on the surface, it is a total mirage.
Completely.
What we're actually watching is the real-time collision of global energy grids, pivoting to support AI, Wall Street mechanically engineering complex derivative wrappers, state-sponsored actors utilizing untraceable cyber espionage, and sovereign governments aggressively walling off their capital markets.
Yep. The fundamental plumbing of the financial system is being completely ripped out and replaced while the price barely moves a muscle.
And that leaves us with a critical structural thing to consider as we watch this space mature.
Yeah, I'll leave you with this final thought. As physical mining facilities transform into AI data centers and global investment banks wrap these digital assets in regulated yield-bearing ETFs, we have to ask ourselves,
Okay.
in a decade, will the decentralized network have actually disrupted traditional finance? Or will traditional finance have simply bought the network from the inside out?
Wow. That is a heavy structural thought to end on. You really have to look past the stabilized surface to see the machinery spinning underneath. Thank you for joining us for the week that was. Keep questioning those surface-level narratives, and we'll catch you next time.